Tyler, Warren Buffett's annual shareholder letter came out this past weekend. And coincidentally, Berkshire's 13F, which is its disclosure of stocks that it holds in its portfolio, came out the same day. And it's rare those two things happen at the same time. We're going to focus on something on the 13F, and that is that Berkshire completely exited its position in a home builder stock, one of the big home builders. But you and I have got a couple of home builder stocks we like better anyway that we think are better buys right now.
Home builders is one of the few things that we're like, man, we wish we could talk about more, but most people don't want to talk about it. But thankfully, we got good old Uncle Warren to help us out and give us a reason to talk about home builders again. So thanks for that.
We'll take what we can get, and hopefully we can expose some people that might not normally look in this area to this great secular tailwind driven opportunity if you buy in the right companies. I'm Jason Hall. This is Investing Unscripted. And this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, we've got a deal for you. Go to our special link. It's fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. You should definitely check that link out. Okay, Tyler, Berkshire Hathaway held a small position in DR Horton, ticker DHI. In the grand scheme of the Berkshire portfolio, it was a pretty small investment. It was the 43rd largest position in the portfolio, just to put it in context. But they didn't hold it for a long period of time. But the whole idea was the valuation looked compelling, particularly when you think about Horton as one of the largest home builders, solidly profitable, and its ability to leverage the massive demand for entry level and more affordable housing and ride that tailwind for great margins of profit in the years ahead.
And an additional little component when it comes to the home builders too is with the current market for housing seized up from higher interest rates, new home sales have become a much, much larger component of total sales of homes. And home builders have this little added incentive. It's called a rate buy down, where what they will do is they will buy a couple of points or percentage points on your mortgage rate. So instead of you getting a 6.5% mortgage, they will buy it down to 5.75. And it's like a sweetener to help you get into the home. And with higher interest rates, it really helps to get the juices flowing a little bit in the housing market and pushes more and more people towards new homes, which is very advantageous for home builders today with more or less a stuck housing market. I was looking at most recent numbers, and compared to 2019, home sales are like down 30% on average. It's just a much, much slower market. And specifically to Berkshire Hathaway's investment in DR Horton, I think we mentioned this when they made the acquisition 6 months ago, maybe. The three that it bought at the time were Lennar, DR Horton, and NVR. DR Horton already gave the ticker, Lennar, LEN, and NVR ticker and the name, same thing. Part of the reason that and this is just my kind of cockamamie theory, is that he though or Berkshire bought those three because they also just happen to be the three biggest home builders. This is a pretty small industry relative to a lot of other things that Berkshire buys. And if Berkshire wanted to make a considerable investment in anything else, any other company in this industry, you'd have to buy almost a controlling stake of it for it to even matter. And so there was part of me that says, I don't know if DR Horton was the best investment that Berkshire could make in the home building, but it might have been the only one it could make.
Yeah, I think that's probably the case. Buffett has talked about how Berkshire's scale and size has become a detriment to he and Ted and Todd's ability to leverage the best opportunities out there because they have to deploy so much capital for it to move the needle for Berkshire. I don't know about you, Tyler, but I'm pretty sure you're in the same boat as me. You're not weighed down by hundreds of billions of dollars of capital to deploy. So
I
we
wish
can
I was.
be
I
more
wish I
flexible
was.
and take advantage of some of those opportunities. You and I have some stocks, some home builder stocks that are under the radar that we think we'd rather buy than Horton anyway. Like you said, to coin turn a phrase from A White Christmas, you're no Superman, but you're awfully available. I think that was the case for Horton. We've got some Supermen we can talk about here. How about you go first?
Yeah, so I'm going to start with, I think, arguably my home builder I like the most. It's called Green Brick Partners. They're you'll never actually see them on a build site because they don't actually build under the name Green Brick Partners. They own several operating subsidiaries under different names. One of the things that I've always greatly appreciated about Green Brick Partners is we're not just going to build for the sake of building. We are going to be pretty conservative in our underwriting of our business. They're one of the companies that instead of some home builders option lots from developers and then just, hey, we'll take a completed lot and we'll put a house on it. Others develop the land themselves. Green Brick tends to develop the land themselves and they get higher margins because of it. And as a result, it exposes them a little bit more. But because I do appreciate, like I said, they're really good at underwriting what they do. They keep a conservative balance sheet and they're really well plugged into the markets where they're at. They're really have a lot of presence in Dallas and Austin markets in particular. It's not a big home builder, so there's a lot of opportunity for growth here. And management has been very good about, hey, it's a good time to buy back shares because they're either cheap or we just don't think it's the best time to be investing in new lot and lands. And so when you see things like that, it looks like a management team that really cares about capital allocation. And that has really shown up in the results over the past several years. And it's why I've owned them and will likely continue to own them for some time.
I also own Green Brick Partners. I think you actually put it on my radar probably 4 or 5 years or so ago. It's done really well. Their capital allocation model is smart, and land, labor, and lumber, right? The 3 laws of home building. It's having access to the land, having access to labor, and then your materials costs. They've done a pretty good job of managing through all of those various aspects of building homes in the way that it can be so dynamic and fluctuate quite well. I'm going to talk about a larger home builder. It's one of the top 10 home builders. That's Meritage Homes, but still not at the scale of the big 3 that Berkshire bought and Lennar, the one that it sold. The thing to me that is so compelling about Meritage Homes is Steve Hilton, the founder of the business, who is still involved as the chairman, has done and just an incredible job of leading this business and transitioning this business over the past 6 or 7 years away from where the money was to be made coming out of the financial crisis 14 years ago, which is building custom homes, and making that transition to starter homes and that first move up homes probably 5 years ago. And the business has basically completed that transition now. And they make the majority of their money building spec homes. So instead of you have somebody that's want a custom built home and they make a deposit and they ride out with you to go look at it as you're building it and they visit you for the 3 or 4 months it takes to build it. And then they buy the house when it's done and they've been under contract the whole time. They start building the house before they have a buyer lined up. And that's becoming a bigger and bigger part of their business, as you see. And as a result, they actually get better margins because these houses are a lower price, but without custom, your labor costs go down. You can have standard floor plans and you can make them quicker and you can get better gross margins. As a result of this focus of where the most of the demand is, they've been able to consistently stabilize and grow their order book. If you get into the second half of last year, orders were up 50%, 60% in the third and fourth quarter of last year. After the big decline that we saw, Tyler, in the 3 prior quarters, which is largely because of the interest rate shock and also the depletions of their inventory that so many of these builders dealt with in 2021 and 2022, when buyers were still soaking up houses, existing inventory was tiny, and the builders had inventory to sell. So between the interest rate shock and having so much of their inventory sold through, we finally turned the corner back to big order growth. And I think that's an important thing to remember because even though we talked about those numbers, those big declines in home sales, that's an inventory issue. It's not a demand issue. And I think that's one of the things that makes Meritage Homes to me so attractive is we're seeing that order book continue to grow. They've been really disciplined about how they acquire land, mostly using options, some owned land as well, and really focusing intently on that entry-level housing market where there is so much pent-up demand. They're able to be where consumers can actually afford to buy. Here's the thing that really puts this so high up on my list of really compelling home builders to buy right now. This is a business that's made that transition from really being a growth story over most of the past decade to being a larger, more mature business that still has a lot of growth built in, but is turning into an income investment as well. So they increased a quarterly dividend from 27 cents a share to 75 cents a share. That's at recent prices, that's pushed the dividend yield up to about 2%, Tyler. For those of us who were fortunate enough to buy the stock a long time ago when it was cheaper, the yield on that cost is pretty compelling. This is the other thing they're doing that I think is interesting and compelling, and it's a minimum share repurchase with an option to buy more. So they're now saying that they're going to buy at least $15 million of shares each quarter for the rest of the fiscal year. and they're holding the option to buy more. And in general, I think you got to be careful with this because the stock's not a deal at any price. And if you're committing to buy 15 million every quarter, you're committing to buy it at any price, right? Which means you could overpay. But this erases the stock-based compensation, right? So they're basically turning that non-cash expense into a cash outflow, right? And I think it's healthy to be upfront about that, right? So you're doing that. And also, they are going to be opportunistic about buying back shares when they do see good value points. And that creates per share value for investors. So I think you put quality of the business, the tailwinds, where they focus in the housing market together, the economic returns, the promise to return capital back to investors. And I think Meritage Homes is incredibly compelling right now.